Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. In this third part of the episode on scalping, we continue with the idea of market structure statistics. We'll look at how non-trending days behave and examine breakout patterns in both morning and afternoon sessions, on the upside as well as on the downside, slicing the data further based on day of the week. We'll also briefly touch upon the importance of building indicators that can track these market structure related statistics live during market hours, helping us observe these patterns as they unfold. So without further ado, let's get started. Disclaimers first. The ideas and examples shared in this episode are strictly for educational and illustrative purposes only. Nothing discussed here should be construed as a recommendation, investment advice, or a solicitation to trade. Trading in derivatives involves significant risk and can result in complete loss of capital. The examples and data presented are meant to explain market behavior, not to suggest that similar outcomes will occur in the future. Outside of the risk disclaimers, note that this episode is data heavy and may need you to pay close attention to the numbers to make any sense of it. With the disclaimers done, let's get started. In the last episode, we looked at trend days. Now let's focus on what happens the rest of the year, non-trending days that is. As we saw, trend days are only 18% of the year, which is close to 45 days. We have approximately 200 non-trending days then. Now there are multiple patterns that play out on non-trending days, but again there is no consistency. I did an exercise in futility just to show you that. Let's say we use the data from the 3 segments of the day, the way we defined it earlier, and we wait for the first 2 hours. Then we use the close price of the first 2 hours as an anchor to define the day structure. The base, which is S1, can be positive or negative. If the close of S1 is greater than the open, then it's U or an up day. Else it's a D or a down day for S1. If the second segment close happens below it, then it's D or down for S2. If the third segment, that is S3, also closes below S1 close, then it's again D or down for S3. That way you will get many patterns. The anchor remains S1 up or S1 down. Let's say on a given day the markets opened at 23,900 and at 11:27 the close was at 23,830, which means the market went down by 70 points. Hence, S1 is down and is labeled as D. Now we check the next segment's close at 1:27 and that is at 23,870. So that's greater than S1's close, so it's marked as U. Lastly, we have S3 and say that closes at 24,050. That's again higher than S1's close, which was at 23,830, so it's a U again for S3. Using this labeling method, you can get different types of days. All we need is S1 as an anchor, and based on S1 you can have an up day or a down day for S1 that is. After that, we can try and see what kind of pattern plays out. Let's say we take all days where S1 was up and see what happens next. This table tells us exactly that. If you notice, it's all random and equally distributed. There is no single pattern that repeats, other than UUU, which means the 2 subsequent closes of S2 and S3 are above the close of S1, which happens close to 29% of times. Now let's look at days where S1 closes in negative. Again, an equal distribution in terms of structure. A downtrend is even less common than an uptrend. So clearly, predicting day structure in this manner is of no significance. So you may ask, what really works? As shared earlier, keeping range numbers as a reference is key. Markets move within specific ranges. Now look at this chart. Look at the 20-day moving average of daily range as a percentage of open. you will see that range is by itself mean reverting. In low range regimes, expecting massive breakouts is futile and perhaps it's better to stay out. So that's one. The second thing that stands out based on the data is that trend persistence is greater at least within the first 2 hours, and next is the last 1 hour. Meaning, if the breakout happens on the upside after the first hour of open, the odds of that direction continuing for the next 20 minutes are greater than the same happening on the downside. Now let's explore the S3 window and see how the breakouts play out over there. Again, we see a visible edge around 215 and 245 windows. Surprisingly, even here, it's the upside breakouts that have a better edge than the downside. One thing is clear as expected earlier, the action is in S1 and S3 windows. As a scalper, if you are looking for trend persistence, maybe you should have a long lunch during S2. But there are perhaps regimes at play here. Look at the year-wise distribution of AM breakouts versus PM breakouts, which means morning breakouts versus afternoon breakouts. There are years like 2023 where all action was in the afternoon, and then 2024 it shifted to the first half, 2025 nothing worked, and 2026 the action is back in the afternoon. So if you are not tired of looking at this data so far, here are some interesting day of the week effects on Nifty. Now from a day of the week perspective, some patterns that stand out. Tuesday is the worst day for mornings or AM breakouts, bleeds across both windows, but flips to the best day for afternoon breakouts or PM breakouts. Monday is weak for afternoon breakouts, flat to negative on both windows. Friday morning, that is AM, is strong, perhaps the best AM day. Wednesday PM 215 especially seems excellent. Lastly, Tuesday AM-PM flip is the most interesting anomaly that I see. Morning breakouts on Tuesday fail, but afternoon breakouts follow through strongly. Before we close, the practical question is, how do you track these patterns as they unfold live during market hours? This is where building your own indicators can be genuinely useful. For example, you can code a simple range indicator or use one that is already available on platforms like TradingView. It is just a live high minus low calculation for a day. One useful variation is to express the current day's high-low range as a percentage of the average range over the past 5 days. That gives you an immediate context on whether the day is still muted, developing normally, or already stretched. You can also code a range by time indicator where you can measure range across specific time windows. That way you can see for yourself if the first segment had a low range and maybe a breakout in the last segment has higher odds. Another indicator that can be especially valuable for scalping is distance from high and distance from low. At any point in time, you want to know how close the price is to day high or low, because that context is very useful for pullback trades and for judging whether there is still room for an expansion. The calculation is straightforward. First define the day's range and then measure high minus current price as a percentage of that range. Distance from low is simply the inverse. And finally, keep the day of the week in mind. Some intraday tendencies do vary by weekdays, so having that context in front of you can help tilt the odds a little more in your favor. So after looking at all this data and slicing it and dicing it across, you may ask, what's the summary? 1. Scalping fundamentally depends on price movement, which we can measure through range, the difference between the high and the low price at any given time frame. By expressing this range as a percentage of open, we can gauge how volatile an instrument is and whether it offers meaningful intraday opportunities to scalp. Now, among the major Indian indices, Bank Nifty typically provides larger intraday moves than Nifty or Sensex, making it more attractive for traders seeking bigger price swings. However, higher volatility also brings higher risk, so slightly less volatile instruments like Nifty 50 may be more suitable for beginners. 2. Studying market structure statistics such as the initial 15-minute range and the typical extension after a breakout helps scalpers understand how far prices tend to move once a breakout occurs. Do note these statistics won't predict exact outcomes, but they provide a probabilistic framework for setting expectations around potential move sizes. Intraday range formation also shows clear time of the day patterns. Nearly 70% of a day's total range typically occurs in the first 2 hours between 9:15 and 11:30, making this window one of the most active for breakout opportunities. The afternoon segment of 1:30 to 3:30 can also produce range extensions, especially when the morning range is unusually narrow, though such occurrences cluster in certain months or years. Third is the distinction between trend days and mean reverting days. A trend day occurs when a price moves consistently in one direction across the 3 intraday segments, forming a staircase-like pattern with strong close near the day's extreme. Now, these days are relatively rare, about 18% of trading days, roughly 45 per year, and tend to occur more frequently on Mondays, Thursdays, and Fridays. And lastly, because most days are non-trending days and structurally random, as traders, we can benefit more from tracking range regimes and breakout persistence, especially during the morning session and late afternoon, rather than trying to predict the exact day structure. Overall, scalping becomes more effective when we as traders align our expectations with the market's typical range behavior and timing of the volatility. Now that brings me to the end of this part 3 episode on scalping. In the next episode, we will go into the specifics of how to determine entries and exits for the trades. I hope you found this episode useful and interesting. I know this episode as well was heavy, filled with data, so do watch it again to understand it better and maybe have a cup of coffee and a notebook handy, and that should help you follow along. Do share your questions, thoughts, and feedback in the comments, and I will do my best to respond. Thank you for watching and see you in the next one.